Joe Allersmeyer, Deutsche Bank analyst, joins us now. His top picks include D.R. Horton and Pulte Group. Thank you so much, Joe. So I just wanted to first get your take on the new numbers out this morning with new home sales, much better than expected.
Absolutely, and I'll even go so far as to say I was more excited to see the home price data. I think the new home sales data was predictably strong given what we heard from the builders over the last several weeks. And there's also other measures of new home sales that came out last week, including the Zonda index, which actually gets a bottom-up look at some of the communities in the country, about 60% of the communities. So this number was actually not that surprising. We think that the home price appreciation that we saw in the Case-Shiller CoreLogic Index, as well as the FHFA Index, tells us a lot more about the strength that we could see in margins coming from the builders over the next several quarters.
How much of these gains do you really attribute to the housing supply shortage, and how long do you see that lasting? And I'm asking you this in the context of your belief that home builder stocks will go higher from here.
Certainly, and a big part of our belief that the builders go higher from here is on valuation. So on price to book valuation, which is traditionally what a lot of investors use, because the value of the balance sheet is actually very correlated to the value of the inventory that these home builders are building homes on. Those valuations are not at all-time highs. In fact, they were much higher in late 2020 and then all throughout 2021. And really, that's what keeps us bullish on where they can go from here, because in reality, the book valuations are tied to the returns, they're tied to the earnings. And so right now you see very high returns on inventory from the builders. Those are going to need to come down as you see home prices stabilize. But we still think that those returns on inventory will be higher than pre-pandemic for many of these builders, and that their price to book values will rise as a result.
Where do you think the Fed funds rate needs to be to see this supply normalize? You have this trend, obviously, of people who got mortgage rates so low, they're not going to go anywhere anytime soon, and that has restricted supply. Where do you think Fed funds needs to go from here for that dynamic to shift?
It's a great question, and I think the answer is slightly different than the question. I think it's not necessarily a destination rate. It's not an absolute level. It's stability in the rate. I heard Bob Pisani talk about stability in rates. I think that's what's really important here for home builders. You see it in the demand that's coming through the sales centers for them. It's really about last year, home buyers came into the market with a certain budget in mind that incorporated a 2.5–3% mortgage rate. And by the late spring, they were looking at payments that were significantly higher because of the rise in interest rates. You're not seeing that this year. People that came into the market are seeing much the same interest rate that they saw at the beginning of the year. And builders are also working with buyers, even if it's still only on a selective basis now, to buy down rates, make sure they can get into the payment. And so that's what is really more important, is the stability in the rates, not so much the absolute level. And that's why you're seeing really strong data here at 7% mortgage rates, nearly 7% mortgage rates.